Thanks, Patrick. So controlling investment income, what are some of the reasons? For clients, who are Medicare age, avoiding Medicare surcharges. So, a bit of a premium, if you're single, if you make over $85,000 in your tax return, or joint if you make over $170,000. And there's different levels. There's another level at $215,000, things like that. So avoiding things, avoiding those different surcharges. Also just paying tax bills that are unnecessary, right? I think, as we move the slide, as we move on, we have this tax bracketology approach. The idea is to not have, 1 year I'm in this bracket, the next year I'm in this bracket, right? But it's reduce that variability year to year, for our clients, so they have a peace of mind as they go through it. So, but let's look at a portfolio and things that you can do to control some of that investment income. First of all, cash. There's no liquidation happening with cash. We usually keep at least 3% on average in client accounts. Specifically for these purposes, quick liquidity needs. We can get cash out quick, and of course, there's no taxability there. The next thing is fixed income. Let's swap some of those, depending on your tax bracket, let's swap some taxable bonds for tax-free municipals. And the way we do it, right now, especially with the whole COVID environment and what's happening with states and municipalities, some municipal bonds have been hit pretty good because of the drop in tax revenue. For us, we're buying fixed income. We're not buying the individual issues. We're buying more ETFs. So that reduces a lot of that default risk, right? Especially if there's hundreds of bonds in one position. Equities. When we look at equities, what's interesting is you're probably getting more yield from, let's call it the S&P 500 than the 10-year Treasury right now. So dividend yield is actually a big part of income, of an income strategy now out of an account. But we don't look at we don't look at income as just yield, either on fixed income or equities. We think capital gains is a big component of that. But we want to be able to control those capital gains. So, for example, we use a lot more exchange-traded funds than mutual funds. With mutual funds have a money manager, and they essentially control those cap gains, right? For us, if we're using ETFs, we have a lot more control over the distribution of capital gains when it comes to the equity portion. So things like that, that's a great way for us to control that investment income when clients are in retirement, or even not in retirement, at any time. It could be even more imperative if they also have other additional forms of income. But I think Patrick is going to take us through the charitable side of the equation as well.